Morning, everybody. My name is Janie De La Rosa, and I am the Chief Sales Officer for Heffernan Employee Benefits Division. I'd like to welcome you all to Heffernan's webinar series. And today's topic is going to be alternative funding from level funding to self-funding. I'd like to introduce our speakers this morning. Meredith Hunter, who is the Vice President of Program Management, and Brett White, who is the Senior Vice President of Sales. Brett started in the stop loss industry over 25 years ago and has been working as a wholesaler for the last 17 years. He's been with Amwins now for the last 15 plus years and is the Senior Vice President of Sales and Stop Loss for Stealth Partner Group, LLC, which is an Amwins company. Brett, I'd like to welcome you to the table.
Thank you, and I hope everyone can hear me. Thank you for the introduction. We're excited to be presenting here today. Happy to have Meredith on the team today, as she is truly the subject expert when it comes to alternative funding and different arrangements for dealing with your medical plan. So happy to have Meredith. She's going to do most of the presenting today, but I did have a couple of slides that I wanted to go over as well. So with that introduction, we're going to go ahead and jump in and we're going to start off by giving you kind of a landscape of what we're seeing in the market these days, and then get into some of the alternative funding arrangements that are available, and then talk about kind of how they work and some of the pros and cons to each one. So with that said, this first slide kind of speaks to what I think most people generally know, is that the larger a case, the more likely it is to be self-funded. This slide breaks it into many different slides. We've seen growth not only in the self-funded industry as a whole over the last 5 years, but most specifically down in the range on the left, the employer groups from 50 to 199 lives, as well as 200 to 1,000 lives. That is the area where we're seeing the most significant growth these days. A lot of those employers, I think, traditionally felt they were too small to self-fund, but now with some of the additions of level funding, as well as captives, there are also fully insured carriers that are using artificial intelligence to look at census, employee level census data, and use artificial intelligence to not only project rates, but can actually use that information for disclosure. And that's really allowing a lot of these smaller to mid-sized groups to enter a more traditional self-funded arrangement. I think the employers are seeing a value in that. Not only is there a potential to save money, but there also is the opportunity to possibly control your own data, have access to your own individual claims, and customize your plans kind of as you see fit for your employees. So the big number on this slide is at the bottom. 65% of covered workers are in a self-funded plan today. Probably many of them don't realize it. I think most employees, if you ask them who their insurance carrier was, even if they're on a very big company, would think that it might be Anthem or United or Cigna, because that is what is on their medical card, not realizing that that is really their network or their administrator on the case, and the employer is actually the insurer on that case. So 65% is the vast majority there, and that number continues to grow, specifically within this smaller segment of 50 to 1,000 lives. So with that being stated, Meredith's going to talk a little bit about some of these other products and how we kind of look and compare fully insured and level funded, self-funded, and captive programs.
Thank you, Brett. Before we jump into the potential solutions, I really think it's important to highlight what the actual issue is that we're trying to address. So if you think about the fully insured market and the cost associated with the fully insured market, we have seen premiums increase around 17.5% for single coverage, a little over 20% for family coverage since 2017. Back up a little bit further to 2010, we've seen premiums increase nearly 54% for single coverage and nearly 60% for family coverage. And while we're watching these premiums continue to increase, we're also seeing employers transfer expense to members through member cost share and payroll deductions. So we've seen an increase in payroll deductions by nearly $1,600 dollars annually since 2010, an increase in the actual deductible by nearly $700 since 2010, and out-of-pocket maximums above 3,000 have increased from 35 to 62%. And so not only are we seeing an increase in the premiums due, we're also seeing an increase in the shift to member responsibility as an impact of increase in premiums. So there are several different types of funding arrangements that exist in group health world. We'll start with fully insured. So generally speaking, groups that are looking for the lowest level of risk choose fully insured. In exchange for a specified premium, 100% of their claims are covered by the carrier partner. A lot of groups that are risk averse choose to go down this path. It's something that is stable and accountable, and they don't have to worry about fluctuation in claims. I would say the one thing to consider is that because the level of risk is so much lower, so is the level of reward, meaning you essentially are not rewarded for outperforming any loss ratio that was expected by the carrier partner. So the carriers generally try to achieve somewhere below an 80% medical loss ratio target. And none of the difference there is kept by the group. It's all kept by the carrier partner that you're using for a fully insured product. So there's really not an opportunity to win in the fully insured space. The next option is level funded. So this is a funding arrangement where you partner fully insured aspects and self-insured aspects together as a transitional product, we'll call it. And so this helps your employers that are willing to take a little bit more risk in order to potentially benefit from a positive claims year. The other great benefit of a level funded product is the access to additional reporting. While you're not getting full claims data as you would in a self-insured arrangement, you are getting more than just a medical loss ratio report when you move to a level funded space. And essentially how this works is you're paying a fixed premium, PEPM, each month, and they're pricing it based on what they expect 100% of claims to be. If you go above that, there's certainly a pool that they can pull from. And then months that you outperform, that money sits in what we'll call an account for the months that perhaps you go over what the expected is. And then at the end of the policy period, there's a settlement that takes place. And so that in that settlement, any months where there was surplus funds, those surplus funds can go to offset any months where there were deficits. And then there's a balance, and whatever that balance looks like, a percentage can be earned by the group health plan. Usually it's a relatively low percentage, but certainly an opportunity to win. Minimum premium is very similar to a level funded product. Essentially, you're paying out a fixed PEPM, the lowest amount possible on a monthly basis, and you have claims dollars and reserves as an offset for that. There's also a return of premium policy available too, so that there are multiple different types of options within this sort of middle risk layer, we'll call it. Higher risk, higher reward options are captive arrangements and self-funded arrangements. The benefit to a captive is that there's real opportunity for a return. So it's a pooling product. Multiple groups are coming together to fund what is known as a captive layer. And claims that fall within this layer are funded by the funds that each group contributes to be a part of the captive. And if there is a balance at the end of the policy period, those dollars are returned to all participating groups that have a surplus position within the captive layer. So there's a great opportunity for reward within a captive space. The other great thing about a captive is that you really have the ability to leverage the law of large numbers. Because it's a pooled arrangement, not only are we looking at one group's specific population, we're looking at the captive population in aggregate. And so that helps stabilize claims experience and helps our underwriting partners price the program more effectively, which is a great advantage. The law of large numbers also helps from a negotiation perspective. And when you think about cost containment programs, certainly the more employees participating, the better the cost advantage for those types of programs as well. So a lot to take advantage of in the benefits captive space. And you are also going to have access to all claims data as a participant of a captive arrangement. Self-funded. This is obviously the highest level of risk, but also a higher level of reward. And so you really are responsible for your health plan. You pay a fixed cost each month for administrative services, which not only gives you access to a carrier network, but it also pays for people to manage your claims, to manage your premiums, to manage your funding on a go-forward basis. There's also an opportunity to purchase something called stop loss when you are a self-funded client. There are two forms of stop loss. There's specific stop loss or individual stop loss, and there is also aggregate stop loss. Individual or specific stop loss refers to one claimant on the group health plan. And so a specific stop loss or individual stop loss level might be $100,000. That indicates the value that the group is responsible for paying prior to the carrier taking over claims. So in the case where it's $100,000, the group is responsible for the first $100,000 worth of claims for that individual. And then anything above that $100,000 for that individual is paid for by the stop loss carrier. Aggregate stop loss refers to the group in aggregate. So there is something that is called an attachment point. An attachment point is some percentage over expected claims. And so if a stop loss carrier expects claims to be $1 million in a given plan year, the attachment point likely would be 125% of $1 million, which would be $1.25 million. Your attachment point being at $1.25 million is where the stop loss carrier would take over paying all claims for the group health plan for that policy period. Anything up to the $1.25 million, the group would be responsible for paying, with the exception of the individual stop loss level, meaning they'd never pay more for each individual claimant over that individual or specific stop loss level. Any questions so far? Okay. So I love this slide because it really tells a story about the considerations that go into play when determining what the best funding arrangement is for your group health plan. When you're looking at a fully insured arrangement, you have guaranteed total premium. You know what your out-of-pocket is going to be for the policy period. No ifs, ands, or buts. This is your PPM. It might fluctuate slightly if you have more employees come onto the plan, or employees go off of the plan, but you know what your PEPM is going to be for the remainder of the policy period. The cons are limited data. So we know very, very little about the employee population as it relates to health risks. We aren't able to see trends or high cost claimants or drivers of healthcare spend. So it's very difficult to solve for the conditions and or claimants that are driving the cost of the health plan. Restricted access to solutions. Generally speaking, there are no carve-out opportunities when you are in a fully insured environment. You are also generally limited to whatever offerings the carrier provides in terms of cost containment solutions. And then you're also limited in plan design. So where you can generally pull levers to help offset expense or to steer members to more effective solutions, you are not able to necessarily do that on a fully insured platform. The second option being level funded, the pros there are you have a maximum monthly exposure. So you know what your maximum is going to be that you would pay in any given month. You're also rewarded for outperformance, assuming that your loss ratio is better than what was expected. You earn some of those funds back. The cons are you still have limited data. While you have more than what you would get on a fully insured platform, you don't have full access to the group's claims performance. You also continue to have restricted access to solutions and limited plan designs under the level funding arrangement. Self-funding, the pros there are that you have access to data, so you can really make changes within the group health plan that will eventually lower the overall spend for the group health plan. You also can customize plan designs to be more proactive and steer members to the right solutions, and certainly help with tiering on pharmacy as well and what that looks like. And then access to tailored solutions. There are carve-out opportunities. You certainly have the ability to go outside of your carrier partner to pull in vendor options that have meaningful impact on your employee population. The cons of self-funding are the risk of maximum exposure. And so the maximum exposure typically exceeds what you see in a fully insured rate. And so that is the risk that you're taking going fully self-funded.
Thank you, Meredith. And I think that translates well to this next slide because I wanted to talk here a little bit about that max exposure. What you're seeing here is kind of the way we compare a group that's currently fully insured to the risk exposure that they're going to face in a self-funded basis. So I wasn't sure whether or not to use this slide because it can be a little busy and sometimes a little confusing, but I know Heffernan hangs with a pretty sophisticated crowd, so we're gonna give it a go. So I'm gonna explain it first, and first off, this illustration does assume that the self-funded plan would have stop loss protection. So if we look at the top, we can see the TPA fees. That would include network access, any fees associated with the administration of the plan. It also includes a broker compensation piece, as generally that's not going to be included in the rate, so we need to add that in. So we're trying to compare on an apples to apples basis here. So, and then everything below the line is going to be compared to this fully insured premium. So in this example, the fully insured premium is about $1.878 million. So that is our set number, and then everything that we're comparing it to below this line is based on that number. So more often than not, you're going to see two numbers when looking at a fully insured plan: the expected cost, which is in the middle there in the blue, and the max cost, which is there in the red. So when looking at the expected, in this case, these numbers would come from most likely a stop loss proposal where we've analyzed the demographics of the group, any claims experience that's in there, those types of things. Underwriters provide us with a quote, and on that we can calculate the expected claims here in the blue. So in this scenario, we have $1.854 million of expected claims. Right below that in the blue, that translates to a 1% savings. And then the line below that in the blue, a dollar savings of $24,298. So in this scenario, the expected return for the employer is about $25,000. So that is where we expect things to come in. But then to speak to Meredith's point about the maximum exposure, that is over here on the far right in the red. So in this scenario, the maximum exposure, by the time we put corridor on there, and assuming this plan has specific and aggregate coverage, the maximum exposure would be $2,131,786. That translates to 13% loss. So it's obviously more expensive. And in that scenario, it would cost the client $252,000. So those are the numbers that often are presented in a self-funded plan, but that is kind of the worst case scenario. Why I like this chart is it talks more about what if things run well and the claims are not as high as expected. So if we go to the left and the far left in the green and the 80%, if it run at 80% of expected, you're running at 1.6 million. So it would translate to a savings of 13%, or that same basically $250,000. So while we do have to be aware of the worst case scenario here in the red, we also don't want to dismiss the opportunity that the claims will run better than expected, and that even increased savings from what would be the 24,000 are potentially there. So where it gets even a little more confusing, is down here at the bottom, where analytics teams and stop loss underwriters have come up with this chart to kind of predict what are the chances that your claims are going to run in a specific area. So if we look down the top line here on where it says 80% is 10%. So the bottom line below that is just adding the top lines together. So there is a 10% chance that this group will run at or below 80%. So there's a 10% chance that they would save the $246,000. An additional 19% chance that they would be somewhere between 80 and 90%. So basically there's a 29% chance that they would save 135,000 or more. And then as we continue to go over to the blue line and add the 30%, which is the most likely because that's where it's expected, we're now saying there's a 59% chance that this group is going to save money, because as we noted before, the expected in this scenario does save them money. So you're getting basically 3 to 2 odds that the plan is going to save money, plus you get access to that data and some of the other benefits that Meredith had talked about self-funding. Now, obviously is the other side of the spectrum. You've got the 22% that it could run in 100 to 110, and an additional 18% at 110 to 120. So there are going to be years where these claims are going to most likely run worse than expected, and claims are going to cost a little bit more than fully insured. But over the long haul, in a long-term self-funded relationship, the odds are going to tend to win out, and you're going to run in this 59% range. So keep in mind that this is from an example. The expected in this case is fairly close to the fully insured premium. Sometimes we'll see quotes where 110% of expected is still going to be better than the fully insured premium. And so in those scenarios, you're going to have an 81% chance of making money. Conversely, there could be some where the expected premium is much higher than the fully insured premium. And on those, we might say you only have a 15 to 20% chance to save money. It may not be the right time. Fully insured may be the best option for you. So with all that said, I don't want to open it up to questions on this one right now because I'm afraid I'd take the rest of Meredith's time, but hopefully if you have any, we can circle back to it at the end. But my final point on this slide is basically there's more than just the expected and the maximum to consider when looking at the costs of a self-funded plan. And that's kind of what those green and those yellow areas represent.
Okay, so just to put a finer point on maximum liability, I think this is often the fear and sort of the issue with groups transitioning from fully insured to a self-insured environment. We did a study to determine what the actual probability is of a group hitting the maximum. And what we have determined is that reaching the maximum liability is the lowest probability of all possibilities. So assuming you have a 10% chance of hitting your maximum liability each year, the chances of you actually reaching it 3 years in a row are 1 in 1,000. And so if you've received a negative rate adjustment in the last 3 years, 5 years of what would 5 years on your fully insured renewal look like? We typically see trend. So current trend is around 7%. If you receive trend over 3 years, your fully insured rates have increased 22.5%. What this is illustrating is compounded interest or compounded renewals. And so if you receive an increase year over year over year in the fully insured space, you're going to see that compounded year over year over year. And so in this example where you're getting trend, usually you're going to get slightly more than trend. It's around 22.5% in this exact example, where you have certainly the opportunity to have decreases or claims value decreases over time in the self-funded space. So we've talked a lot about fully insured. We've talked a little bit about level funded. We've talked a lot about self-insured. I also want to spend the next few minutes talking about captive arrangements. Captive arrangements are fantastic opportunities for current fully insured groups that are looking to transition into the self-funded space, but perhaps there's a bit of reticence due to concern over the maximum or due to their group size and having more volatility as it relates to claims year over year. So who should consider a captive? We generally look at group size, anywhere between 50 to 500 enrolled employees. We can go a little over that 500, but that 50 is a pretty hard and fast rule that we need a minimum of 50 enrolled for stabilization purposes. Does your client want to manage their health plan like they manage the rest of their business, meaning that they can make independent decisions around their plan design? Perhaps they want to carve out their pharmacy to a unique PBM that allows for 100% rebate distribution. Perhaps they want to have a customized plan design where they steer members away from the emergency room by increasing the cost share substantially on that piece. Are they forward thinking in terms of coming up with a strategic plan for the next 3 to 5 years in hopes of a return on investment? What we mean by that is it's hard to make a plan if you don't know what the issues are. And so having access to reporting and better understanding utilization within your health plan is certainly going to help you make better strategic decisions about your health plan. Willing to implement robust health and wellness or cost containment programs. One of the great things about a captive arrangement is that it generally is like-minded employers that are looking to truly make a difference in their health plan from an ROI perspective. And therefore, they're invested in products and programs that effectively reduce their medical loss ratio year over year over year. And we certainly can help support and guide you in selecting vendor partners and or specific programs that meet the needs and address the issues within your particular population. And then finally, looking for financial stability within their health plan. So we talked a little bit about the advantages of the law of large numbers. Being able to evaluate the pool as a whole certainly creates stability for each individual health plan that's participating. So to put a finer point on these solutions that we have within the captive benefit space, when you break it out into the various components of the health plan, we look at administrative expense. The value with administrative expense is that we're often able to negotiate lower admin costs due to sheer volume. We're also able to deliver deeply discounted national networks and narrow network solutions to choose from. So you have the option of RBP, you have the option of Blue Cross Blue Shield network, you have the option of United Choice Plus network, depending on the TPA that you select. You also have access to more PBM opportunities, pharmacy benefit managers, so that you can really pick the solution or the vendor partner that meets the need of your individual group. From the stop loss perspective, we've talked about this a lot, but I'll continue by saying we're reducing volatility and increasing predictability. And so spreading risk out over a larger number of employees creates stability and helps us predict pricing more accurately. So you have more predictable renewals, more level renewals moving forward. You're also getting better pricing and contract terms just due to sheer volume. Access to cost containment solutions. So for our specific captive, you would have access to our gene and cell therapy program, our patient assistance program, and our dialysis management program. You also have the opportunity to bring solutions to the table that work for your population. So if you have an issue with smoking and you want to bring a smoking cessation program to your population or a diabetes management program to your population, we would absolutely encourage you to do that. Pharmacy benefit administration. I cannot speak about this enough. Your pharmacy benefit vendor is critical, making sure that you're partnering with a PBM that is heavy on utilization management, works closely with physicians to better understand medical necessity, that's being very strategic in the way that they design their formularies, designing them so that you get the greatest net savings, taking rebates into consideration. And then also PBMs that are effective administrators. I said to someone earlier today, there's nothing worse than a pharmacy problem. And so making sure you've got a good partner there is critical. And then finally, retaining carrier profit. And so the opportunity to win. If you have a surplus in the captive pool at the end of the policy period, that is 100% returnable to all participating groups. So that is a huge advantage to groups that are participating in captive arrangements. So to take it a little bit further as far as the structure of a captive is concerned, we talked a little bit about the individual stop loss level earlier and the aggregate stop loss level. As a reminder, the individual stop loss level refers to the value that a group is responsible for paying per claimant on the group health plan. So assuming that it's a 50,000 individual stop loss level, the group would be responsible for the first $50,000 of each individual claimant on the health plan. Aggregate stop loss is considering your population's claims as a whole. There's an attachment point that generally is 125% of expected claims. If your expected claims are $1 million, your attachment point is $1.25 million. You're responsible for your group in aggregates claims up to that $1.25 million. Anything above that attachment point, you are off the hook. The carrier pays the remaining claims for the remainder of the policy period. So with a captive arrangement, we have what's called a $200,000 floating captive layer. That floating captive layer sits on top of the individual stop loss level. And so in this case, because it's 200,000, the group is going to pay the first 50 up to the ISL. The next 200,000 for each individual claimant is going to be paid for by the captive layer. And then the risk transfers at 250, 50,000 plus 200,000 to an excess carrier. That excess carrier is going to pick up all remaining claims for that individual for the remainder of the policy period. Well, where do the funds in the captive layer come from? A portion of the group's PEPM premium funds this captive layer. And those funds are what directly pay for any claims that fall within that layer. The captive layer also has an aggregate stop loss level. So we fund the captive layer based on what we expect 100% of claims to be within this layer. The aggregate for the captive layer is also 125%. So if we expect claims within the captive layer to be $1 million, the aggregate policy for the captive layer would kick in at $1.25 million. And then the excess carrier would pay for all additional claims that fall within this $200,000 floating layer. So what do we do to bridge the gap between 100% of expected claims in the captive layer and the aggregate policy that sits on top of the captive layer? We create a collateral bucket. This collateral covers the 25% gap between what we've funded in the captive layer and when the aggregate policy kicks in. This collateral is charged on a per employee per month basis within our captive arrangement. We were very intentional about doing it that way. One, if you charge the full value of the collateral at the beginning of the policy period, it can be a barrier to entry for captive participants. Also, because the collateral is charged as a function of claims, claims fluctuate based on enrollment, and by charging it monthly, we're capturing actual enrollment. And so there's no need for a settlement at the end of the contract period. We, on our captive arrangement, also require a terminal liability policy, and we have advanced funding provisions. A terminal liability policy is essentially an option to exercise runout. If a group joins our captive arrangement and determines that they are not meant to be in the self-insured world, the last thing that we want to do is prevent them from making the right choice for their group health plan. With the terminal liability option, the group will have runout protection so that they can make the choice to move back to a fully insured policy if that's what's in their best interest. The advanced funding provision caps what a group comes out of pocket paying for each individual claimant, meaning once a group reaches $50,000 in this specific example, once that group reaches that 50, everything up and above that is funded through advanced funding. The group does not have to come out of pocket and wait for a reimbursement. It is all advance funded so that the group doesn't have to pay any more than $50K for each individual claimant. We also have a no new laser rate cap provision on our program. No new laser, meaning if a claimant is identified as a high risk, high dollar claimant, the stop loss carrier generally reserves the right to laser that member or remove that member from specific deductible and aggregate stop loss. And so any claim incurred by that particular claimant has to be 100% funded by the group health plan. With the no new laser provision, a carrier cannot add a laser at renewal, meaning that would not be an issue for the particular group, that they couldn't have a member lasered and run the risk of being responsible for 100% of that member's claims. Rate cap provision, ours happens to be 50%. That's the maximum increase that you can receive at renewal, is that 50%. It's really important that you pair those two provisions together. In the event that you only have no new laser, the stop loss carrier could easily increase the rates to accommodate their new exposure for this identified high dollar claimant. If you didn't have the no new laser provision and only had a rate cap, the stop loss carrier could apply lasers wherever they see fit to help minimize their exposure. Any questions on this slide? Okay. So just getting back to what an ideal candidate looks like. An ideal candidate being somewhere between 50 and 500 enrolled employees, an employer that is eager to implement solutions that target very severe health concerns within their employee population, an employer that is willing to band together in a risk pool to leverage the law of large numbers, to actively communicate with the other participants and brainstorm on solutions that are effective for their employee health population. And then an employer seeking value when they outperform what was expected. So being eligible for that return. Any questions from the audience? Brett and I are here and happy to answer anything that you have here in these last 10 minutes.
If anyone wants to ask a question live, go ahead and raise your hand and I can allow for you to speak. If there aren't any questions, then thank you everyone for attending. Thank you, Brett and Meredith, for all that great information. This session was recorded and we will be also sending out the presentation as well. Thank you, everyone.
You.
Thank you.